Good afternoon, everyone. My name is Jeff Urbach, and our topic today is a discussion of the highlights of the Tax Cuts and Jobs Act passed in December. As I'm sure everyone is aware, this tax act has had tremendous implications, tremendous controversy, and what I hope to do today is to spend about 30 minutes reviewing the major top line items and then open it up to questions. So I would encourage you, there's a chat available to type in your questions as we go along, and at roughly around 12:30 or so, we'll be digging into the questions. Okay, so let's just get into it. Just briefly, by way of background, I've been teaching for NJAPM in the 40-hour family mediation program for many years. I'm actually one of the co-founders, and I wrote the finance and tax section. I've also taught professionally around the country in my discipline, CPE courses and things like that. My practice is limited to matrimonial litigation, primarily doing expert witness work, mediation. I'm on the judicial roster for economic aspects of family law cases, as well as collaborative law. And that is the focus of my practice. So with that being said, let's get into it. Okay, probably the item which has gotten the most press and has attorneys and mediators who are not attorneys most confused, if you will, are the alimony provisions. And one of the things that created the confusion was when the law was first announced, it was understood that the alimony provisions were going to go into effect in 2018. This created such an uproar that Congress pushed it back a year. We were in a period in the fall where clients were frantic to get their cases settled with the assumption that the tax aspects of alimony were going to, of this new law, were going to go into effect on January 1st, 2018. And as hopefully most of you know, that's been postponed a year. So we still have a year to absorb all of this. So let's keep in mind that we have pre-act law, which deals with alimony and separate maintenance payments. And as I'm sure you know, under the pre-act law, the payor of the alimony gets to deduct it, and the recipient, assuming that the payor has elected, assuming that they have elected to have taxable alimony, there was always that option under Internal Revenue Code Section 71. You could always opt out of the taxability portion of it. But assuming that the payor is deducting it, the recipient, the payee, must declare it. Child support, of course, is a non-taxable payment, both deductibility-wise and in terms of inclusion in income. And there are relevant code sections that deal with this. Code Section 71 primarily is the one that governs alimony. And I would remind you, and you'll see as we get into this in a couple slides, that even though Code Section 71 has technically been canceled, so to speak, it will remain operative for historical agreements, and I'll discuss that as we move along. So it's not something that we can just forget about today. Okay, so as I said, we've got a lot of material here. We're just going to give an overview, and then we'll dig into the Q&A. There's a lot of materials here that you can take back with you, print out, and reference as you get further into the cases that you're working on. So the new law takes effect for divorce agreements and separation agreements executed after 2018. So for any divorce or separation agreement executed after December 31st, 2018, or executed before that date but modified after that date, alimony and the separate payment and separate maintenance payments are not going to be deductible by the payor spouse and are not going to be included in the income of the payee spouse. So what that means to those of you who are mediating cases now, when we're in the early part of the year, is you need to be mindful of what's coming down the pike as your current cases get a little older and move towards settlement, and B, as new cases come into your offices. So for cases that you're currently mediating and you feel are going to in fact settle in 2018, you have an option. You can calculate your alimony based on the pre-tax law, if you will, Code Section 71, and have that alimony be deductible by the payor and have it be income to the payee. Now, that being said, you also, of course, have the option to settle your agreements under the current law. So you have this window of time where you have both options. So if you choose, you can have non-taxable alimony, and which means it will not be deductible by the payor, nor will it be includable as income by the payee. And what this means is that if you elect the current law, the new law, if you happen to go in on a motion to change what is technically a Lepus motion, a change in circumstances, for those cases that you've done in 2018, you might be a little restricted. So my current thinking in terms of practice pointers is for cases that you're settling in 2018 to leave all of your options open. So you can choose to have alimony under Code Section 71 as taxable and deductible by the payor, income to the recipient, or you can choose to be, and this we're actually waiting on regulations on, so my thoughts here are not definitive yet, choose to still be under this Code Section 71, and historically you always had the option to opt out of the taxability portion. So this is something that we're waiting, we actually have to wait for the Internal Revenue Service to write regulations on. And just as an aside, this is such a complex tax bill. This is only one piece of it. We are all waiting for regulations. And I would remind you, I'm old enough to remember the Tax Reform Act of 1986 under Ronald Reagan. We're actually still waiting for regulations and some very complex pieces of that legislation. So I'm not holding my breath. Okay. So these new rules don't apply to the existing divorces and separations. So it's important to emphasize that the current rules continue to apply for already existing settled cases and separations, as well as divorces and separations that are executed, as I said, before 2019, if you elect to retain this old Section 71 provision. Now, some taxpayers, and this is where you're really going to need to do the math and perhaps even consult with a neutral tax advisor, someone that the parties agree to. You really need to do the math on this. You may decide for early application to choose to have the alimony be non-taxable, therefore non-deductible, and therefore not the recipient doesn't pick it up. That's perfectly acceptable. There's a sea change here. We're all in a transition period and trying to equivocate what we're used to in terms of dollar amounts or percentages, in terms of the differences, let's say, between the earnings of the parties. All of that is new territory for us. And I would urge you to seek out competent financial help, some kind of analysis to work your way through these waters as you settle these cases. Let's talk a bit about what are known as Lepus motions. Now, some of you as mediators may have people coming into your office and their property settlement agreements called for mediation to be the first step if if an application for a change in circumstances is being contemplated. That's what a Lepus motion is. So if in 2019 you're changing a pre-2019 marital settlement agreement or PSA and wish the old alimony rules to apply, you can still do that. You just need to make a conscious decision about what you're doing, and of course make sure that if there is in fact a change that's negotiated, that all of that is present in the new agreement. And as a practice pointer, I would also recommend that your language in those agreements be consistent with the older language under Code Section 71, if that's where you choose to operate on these older agreements. Okay, let's talk about some other things that folks have up until now, at least in my experience, not given a lot of thought to. Payments in kind. So qualified required payments to third parties, as you know, as long as it meets certain requirements, qualifies as alimony. What's different now is that under the new law, if a payment is made to on behalf of the spouse and is considered alimony, it will no longer create this concept of phantom income. What do I mean by phantom income? It means I pay someone on behalf of, I party A, pay someone party B on behalf of my ex-spouse party C. Party C still has to pick that amount up as income, even though party C did not actually make an economic disbursement for that. So this concept of phantom income goes away under the new regime, if you will, of alimony laws. That being said, this is going to make your negotiations a little more challenging, and actually in general, negotiations I think will be more challenging because people are going to look towards the professionals to do the tax affecting as you negotiate these settlements, be that for the alimony or other items. Okay, for many, many years, some of you may know, we've had provisions which prevented what's called the front loading of alimony. Many years ago, the IRS got wise to the fact that people were trying to disguise equitable distribution to make it alimony, and they were front loading it. Now, this was much more relevant literally 30 or 40 years ago when the differences in tax brackets were really stark. Some of you, if you're like me, are old enough to remember when tax brackets were as high as 70 or even 80%. And so if a spouse one spouse is in 80% and the other spouse is in effectively zero or a lower amount, there was definitely an incentive to disguise equitable distribution payments, which have no tax implications generally, to disguise it as alimony. So what the IRS came up with was a 3-year look-back recapture rule. I'm not going to get into that here. It's a little bit technical, but you may have heard of it, and you can certainly always Google it and get that information if you're not familiar with it. But the important thing to know is that those recapture laws are no longer operative for agreements entered into after December 31st, 2018. And I think you see the logic of why that is. It's because the alimony itself is not going to be deductible, nor will it be taxable to the recipient. But you do need to keep it in mind for agreements that go into effect that you settle in 2018 and choose to use the old Code Section 71 alimony rules. If that's the case, then you do still need to be mindful of the 3-year look-back period and the recapture calculations related to that. So I've now taught this actually a number of times, and primarily to matrimonial attorneys. And in the process of teaching this and talking to my colleagues, and there's a lot of discussion out there about what's going to happen to the bargaining power between the spouses. It's well known that if you've got alimony that's deductible, that's often been an incentive for the payor to move towards settlement sooner rather than later. We don't know, because obviously we have no experience in these cases yet, whether there will be a disincentive making settlements A, more difficult to reach, and or B, actually result in reduced alimony awards. Will that happen? I think that what we're going to be doing is having to do a lot of math. We're going to have a mindset of what would the alimony be if it were taxable, and how do I deal with it now that it's non-taxable, and how do I get equivalency between those? I wish I had an easy answer for you. I wish I could say use X percent of what we used to do before, and that's going to get you home. The fact is, there's so many other changes in the tax law that it really does require a much more sophisticated calculation to arrive at equivalency in getting these taxable alimony payments, what would have been taxable, down to an equivalent non-taxable. So unfortunately, only questions, no easy answers for you. We're all, as a profession, those of us who do this work, we're going to have to struggle through that together. Let's talk about prenuptials. You, as mediators, you may have people coming into your office to negotiate a prenup. You may have new divorces coming into your office where a prenup was in effect. What are the problems that we're going to be seeing with prenups? Well, more than likely, when they were drafted, they did not contemplate this major change in tax law, which has been around for, I think, I want to say at least 30, maybe even 40 years, if not more. So you may be looking at prenup agreements that contemplated arrangements assuming the taxability of alimony. And so now if you have a case which is going to settle after 2018 and there is a prenup, there's a world of change. Now, I will caution you in saying we're treading into real technical legal stuff here. But the important takeaway here is that prenups is something that you will be dealing with, and it may require the input of your reviewing attorneys as you mediate these settlements as to what happens with the prenups. I can very much see that someone who has signed a prenup as the payor coming around and saying, but wait a minute, we didn't contemplate in our prenup agreement the non-taxability of alimony, and we need to negotiate this. And that's where our skills as mediators will really come into play. Hopefully we can keep our clients out of court and help them deal with their prenuptial agreements under the new regime, under the new law, in a way that's fair to both parties. And of course, the question is always out there, even for happily married couples, do they wish to renegotiate their prenups or not? That's up to them. You may get couples coming into your office that are otherwise happily married and wish to renegotiate the prenup and want your help. I don't know that they will be happily married when you're done, but certainly that's what our goal and intention would be. Let's talk about the child-dependent exemption, and this is really important. There has not been a lot of discussion outside of the technical community about this, but before this new law, most of you were probably aware that the child-dependent exemption was there, and couples always had the option of doing several things with claiming that exemption. That is, they had the option of trading off, alternating years for exemptions, splitting the children. One takes Mary, one takes John, and there's actually you were able to permanently give your spouse the exemptions under certain circumstances. Now, you may have heard that there's no longer an economic benefit to the exemption, okay? And this is true. But what you need to keep in mind, and this is critical, is that there's something called the child tax credit, not to be confused with the child care credit. That's different. And I've had a lot of people confused about that. This is the child tax credit. And most of us really didn't think much about it because it was relatively small. It was $1,000. And the income, the taxable income levels were relatively low, after which it was phased out, and so the benefits of that evaporated. There's been a sea change in this area. So under the new law, the child tax credit is actually worth $2,000, okay, and doesn't phase out until taxable income of $200,000, talking about someone who's filing single or head of household. So now, all of a sudden, in many of the smaller cases where no one really gave thought to this child tax credit, again, because of the dollar amount, 1,000 versus 2, and the fact that for many of our clients, they've phased out anyways. Now we're looking at many couples who are going to have taxable income below $200,000. They're going to want to take that $2,000 per child per dependent credit. So it becomes very, very important. Now, where I'm finding people are getting a little confused is the fact that, yes, we're no longer getting a dollar exemption for it, but it's important to remember that the credit and the exemption are linked. So I'm holding my hands up there. One follows the other. So the party that gets the dependent, even though they're not going to be getting a dollar deduction as they used to, if there's a child credit that's available, that credit follows the exemption. So your agreements need to take all of this into account because it's just now worth a lot more money. And again, I'm at the risk of being repetitive, it's something that many of us just didn't give thought to in the past, but we need to address it now. As a matter of fact, the Senate Conference Committee report, which is the report which reconciles the House and the Senate versions of the tax bill, addressed that specifically, and in the black letter of the Conference Committee report says that the child tax credit is still linked and that the child dependent exemption is still there for purposes of determining who's entitled to take that credit. So I know I'm throwing a lot of complexity at you, but don't kill the messenger. This is what was signed into the law, and this is what we all have to deal with. Just to review, in the absence of any agreement, this exemption always belonged to the custodial parent, and that hasn't changed. The old definitions under the Internal Revenue Code sections 152, none of that has changed, and that's important to keep in mind. So we're not throwing entire sections of the tax law out just because the dollar amount of the exemption has gone from it was about a little over 4,000 down to 0. It's still very much there, and it's still important. And the rules in terms of who's entitled to take those dependency exemptions are still in place. The custodial parent can always release the dependency exemption to the non-custodial parent in a written declaration signed by the custodial parent. They must state the years to which it applies. They must name the non-custodial parent who is the recipient of the exemption, and it must be unconditional. And nothing has changed in terms of the IRS Form 8332 or a similar statement which is used to effectuate that change. Okay, so this is important. It's something you need to redline. Okay, so this we've covered. I'm going to move on. Just for purposes of reference, these are the old thresholds, and you can see that this child tax credit, which was worth $1,000, phased out after $75,000 in the case of an individual who was not married. So now with a $200,000 phase out, we really need to be mindful of the incomes of the spouses once they are in fact divorced. Okay. A practice pointer, your agreements should provide language to revisit this topic. This is one of the sunsetting parts of the code, of the new law rather. As you've probably heard, there are sections of the law which are permanent. Most of those deal with the corporate and business side of things, but there are sections that will sunset in 2026. This is one of them. So we're going to be now in this period of time in the agreements that we're putting together where the exemption is important for purposes of the child tax credit. And all of that's going to flip-flop, barring, of course, any changes between now and then. No one can predict what's going to happen, but all of this sunsets in 2026. So this is something that you need to cover your bases on. Make sure your property settle, your MOUs, your property settlement agreements, whatever, take all of this into account. A lot of technical stuff in there, really to protect the spouses and, of course, to protect yourself as the one, whether you're a lawyer or a mediator lawyer, whatever your role is. Okay, let me move on. Issues for pre-2018 agreements. You know, you may have cases coming in where spouses have negotiated in good faith for one party or another to claim exemptions that have now been legislated away. Is there any recourse? The attorneys that I've spoken to have all said, yes, this is an issue that can potentially lead to litigation. Obviously, we as mediators have a mindset of trying to help the parties come to an agreement. I think ultimately at the end of the day, this is going to be a cost-benefit issue. I don't think I need to remind you of the cost of litigation, going into court, making these motions, probably having an expert come in and do calculations. So I think it behooves us all to keep the cost-benefit aspect, be mindful of it, but at the same time, you may very well, as time goes on, have people coming into your office to deal with this. So something that is going to be coming your way. Okay, IRAs. Why do I mention IRAs? Simply because if you have a non-working spouse, now that spouse may have been imputed income for purposes of determining alimony, but he or she is otherwise non-working and has no earned income. Under the old law, many people actually didn't know that alimony qualified as earned income for purposes of taking an IRA deduction. That no longer will be in place. So in your agreements under the new law, if the lower earning spouse is not working for whatever reason, and was they always had the option of putting money away into an IRA, $6,500 if they were 50 or older, that disappears now if they have no earned income. So if they're living on capital gains and interest and dividends and what will now be non-taxable alimony, then the ability to make IRA contributions and do some planning for the future will go away. So this is creating another concern for folks, because everyone is of course concerned about retirement and having adequate savings there for it. So not just one more thing to put on your checklist to make sure that you've covered and advised your clients of. 529 plans. What's happened with them that's going to create a potential issue for us? I think we all know that the 529 plans were there previously to fund the college education of the kids, or grandparents could fund them on behalf of the grandchildren. What's changed under the new law is that parents can use up to $10,000 a year out of a 529 plan for purposes of pre-college education, not homeschooling, repeat, not homeschooling, but a private school, whether it's a non-sectarian prep school, a religious school, a Catholic school, a Jewish yeshiva, whatever the case is, up to $10,000 a year can now be taken out of those 529 plans. Now, this presents some interesting issues. Number one, you may have people coming into your office that have already been divorced, and now they're coming in and saying, wait a minute, we didn't agree to use this college money to pay for our children's private education, and so never told me that he or she was taking money out. And now we have an issue, and we are coming to you as mediators to help us resolve it. That's for agreements that have already been signed, and for agreements that you're working on now that ultimately will become formalized. I think it's very, very important that the parties delineate in that agreement whether or not the plans can be, notwithstanding the tax permissibility of it, but between themselves, will they be allowed to utilize up to $10,000 a year per child for private school education? And there should be full disclosure provisions in your agreement so that there's, in my opinion, there should be at least be a quarterly exchange of the brokerage statements or the bank statements, wherever the 529 plan is, so that parties can keep track of what's coming in and out of these 529 plans, so nobody gets surprised at some point in the future. So again, another cautionary tale and something that you're going to want to be mindful of and have in your plans. Okay, so this we've covered the 529 plans and matrimonial issues. I know we're a little bit past half an hour now. There's a few more things I want to cover, which I know are going to impact negotiations. You may know that the home mortgage interest limitations, new home mortgage interest limitations have gone into effect. This may impact negotiations as the deductibility of interest on mortgages is now on any new debt is now going to be limited to $750,000 underlying original mortgage, or a home equity loan used to expand and improve the home, still within the $750,000 limit. So these may or may not come into your negotiations. Miscellaneous itemized deductions. So attorney fees related to alimony, which previously were deductible subject to the 2% of adjusted gross income limitation, that is no longer in the law. Actually, no miscellaneous deductions are there, including tax return preparation fees, stockbroker advisory fees, etc. So something else that your clients may be asking you about and to keep in mind. Okay, I happen to do, one of my specialties is the valuation of small, closely held companies and professional practices. And I just want to just briefly give you a heads up on what's coming down the pike in that area. When we do valuations, we take into account after-tax income. And the consensus historically is we've used about an effective rate of 30 to 40%, very fact and case specific. Keep in mind that the new maximum corporate rate for C corporations is 21%. What does that mean to us doing valuations? I don't know yet, to give you an honest answer. And I am actually signed up for 2 or 3 webinars coming down the pike by the thought leaders in our discipline to talk about that very topic. But this much I do know, valuations will change. How much? It's way too early to figure out. I've given you an example, and because we're running out of time, you're welcome to review it on your own time. But I've laid out a very simple example in the slides here, which show you the effect of moving an effective tax rate from 40 to 30%, and the effect that it has on the valuation, all other things being equal in a company. And of course, the question is, have we created value by the stroke of a pen and the signing of a new tax law? I don't know. That's the honest answer. We don't know, but it's something that we who do this work are going to have to be. We need to get on top of. And you, when you're mediating your cases and you have a closely held business or professional practice, and you're reviewing expert reports, this is something to keep in mind. Okay. Some other changes for small business owners, big changes in meals and entertainment deductions. The tax reform wipes out 50% of the business entertainment deductions. Things like entertainment, golf, skiing, things like that are no longer deductible. Why am I raising this in the context of, we're talking about mediation and divorces? Because if you've got a business owner and that business owner is now going to be paying more taxes for other reasons, unrelated specifically to the divorce, this is going to throw just another wrinkle or complications into the whole calculus of who's earning what at the end of the day, and how much is going to be available for alimony, which of course presumably is going to be non-taxable. Lots of changes for small business owners aside from meals and entertainment. There's something called a QBI, a qualified business income deduction. This slide is here for you both as a mediator, and since most of the people who do mediation, at least the ones that I deal with, including myself, are self-employed, this is something that affects you and I, not only our clients. So I would urge you to consult with your own tax advisor in terms of what these changes are going to mean for you in your mediation and or your law or your mental health practice. Because certainly you may or may not benefit by certain aspects of this bill as a practitioner. Okay. We are a little over time, so brief bibliography of some resources that I've drawn on. I'm still reading things that are coming out on almost a daily basis. We're learning more and more about things, and at my end of the business, we're attending webinars. So this is an exciting time, but it could be a very anxious and disconcerting time because there just are a lot of unknowns out there. And on that note, Carl, I think we're ready for some Q&A. So I think we go to Q&A to chat. Okay. All right, Susan Williams asked, if the payee spouse can't claim it as income for tax purposes, can it be included in total income for such things as a mortgage application? Really good question. My answer is probably. I am not a mortgage expert, but I would speak to the mortgage advisors that you work with. I can't see why it would not be in there. I think all we're doing is we're talking about what may be, all other things being equal, a lower number. But I don't see why anything should change in terms of the availability, the ability to use that. Now, that being said, what may happen is that because the amount of the alimony might be lower because it's no longer tax deductible by the payor, that may create an issue for the person who is on the receiving end of it and wishes to, let's say, stay in the home and refinance the mortgage. So that's a problem that we're going to have to deal with. Okay, let's say Laura Van Tassel, putting through divorce in 2018, alimony for 5 years at a set amount. In 5 years, we agree the alimony should be recalculated, but will have to be done at that time. The new figure will be set for, okay, can we still use the old current? Yes. So as long as you put your divorce through in 2018, and I would say, I like the philosophy of wearing suspenders and a belt, okay? So if you're putting through your agreement in 2018, and you know you're going to be renegotiating this, put in the agreement that your plan is to utilize the existing tax law whereby the alimony is deductible and taxable, but also leave yourself the option, because you don't know what's going to happen in 5 years. Always leave yourself breathing room. Leave yourself the option that you may want to choose otherwise at that point in time. So as broad as possible. Amy Wexler, good. Hello, Amy. It's been a while. How do we get copies of your slides, Carl? Are they posted for the participants? Okay. Carl has mentioned to me that they will be available to you guys. Let's see. So I have answered 3 questions. Are there any? I don't see any more questions out there. Alan, are you out there? Do you see any questions on your end of the webinar?
Jeff, there's a comment by Andrew that says, I do a lot of cases with non-taxable alimony now. Mortgage brokers will look at that. Make sure you have records of payment.
Mm-hmm.
You usually need 6 months of payment to show income and need it in PSA.
Good, thank you, Anju. And that pretty much confirms what my gut feeling had been. There should be no issue that the money is there, but as Anju wisely points out, make sure that your records support that. And again, I think the only real potential problem is the fact that we may be dealing with a lower amount now of alimony, which may or may not preclude someone from otherwise qualifying for that mortgage. Anything else, Alan, I'm not seeing?
No, nothing that I've seen here. You've answered all the questions that have been
Okay.
posted.
All right, so if there's no other questions, I want to thank you all very much for your time. I know that this is can be a it's a pretty complicated topic. It's new to all of us. Stay tuned. There's going to be more to come as we all work through this new law. And I'll make sure that Carl and Alan make provisions to get everybody the slides. Some of you know me out there. I recognize some names. You can always reach out to me personally. I'm more than happy to send you a copy of the PowerPoint. So with that said, thank you all very much. Have a great day. And I hope I've been able to be of some help to you today.